I want to focus on the United Kingdom and the Bank of England as a microcosm of the macro debt bonded slave question in relation to national sovereign debt levels. We will discuss a conspiracy of silence by all parties, black hole problems, and who will save the old lady of Threadneedle Street. I have a picture of NHS patients being stuck in the hallway because the risk is that the old lady of Threadneedle Street cannot be abandoned in the hallway either. The Institute for Fiscal Studies in the United Kingdom, after I had returned from the United Kingdom for research purposes and other purposes on June 6, 2024, published a great piece that I really did enjoy. And they talk about the conspiracy of silence between Labour and Conservative parties before the July election, of course, in which case Rishi, head of the Conservative Tory party, lost to Keir Starmer of the Labour Party. But the IFS piece was about how both parties, up and to the build-up on the election, had, I wouldn't say misrepresented, but were not fully discussing many of the components of UK debt levels, fiscal constraints, and the limitations and barriers for future economic growth opportunities. I would suggest you can go to their website and look into that yourself, but I enjoyed the title so much, The Conspiracy of Silence, that I am utilizing it myself. The picture below here is just the key economic indicators of public finance historically from the House of Commons Library. It's important to note that the explosion of public sector UK debt as a percentage of GDP, or debt to GDP threshold, has really grown since the mid 2000s, especially in the post 2007 financial crisis. The reason that it is a conspiracy of silence by all parties is that the rise of UK debt levels has been unabated for years, if not decades. And so it's important to emphasize that when looking at the issue of long-term debt, financial issues, economic issues in the United Kingdom and elsewhere, that it's really not just the actions of one politician or one party. Oftentimes, it is a long-term trend that is oftentimes the fault of multiple parties and multiple administrations, in the sense that the trend continues unabated without really any change. The past is the past, but what about the future spending and debt in the United Kingdom? This is a timely conversation currently. We'll get into the black hole problems and debate a little bit later. Right now, and recently, the Labour government under Rachel Reeves has, of course, proposed the October budget and potential spending increases, cuts in certain areas, revenue increases, depending on specifics. The future spending and revenue numbers are important to watch as they unfold, because, as we will cover in the next couple slides here, there are high costs to debt crises. The cost of high debt levels is multiple-fold. The first direct cost is debt interest payments and carrying cost. Of course, the more debt incurred, then the higher debt interest payments become, which leaves less money available relatively for government spending in other areas. In the post-financial crisis, global interest rates were lower than historical averages, which allowed developed economies to carry more debt at a relatively lower cost than historical averages, but in the recent time, due to inflationary pressures, central banking authorities have raised interest rates to combat inflation, which indirectly, of course, has led to increased interest payment costs long term for the same government authorities. It does take time for debt rollovers to occur in terms of those costs systematically increasing across the board, but it is something on newly issued debt, for instance, that does lead to a higher uh, carrying cost. These factors mean government administrations have less fiscal resources and range of maneuver to spend money on other areas and benefits. This isn't just true if there's an emergency where there needs to be an increase in government spending for some reason, but it also is for ongoing government services and benefits. It's just not ideal since taxpayers see less return on their marginal tax dollar back in terms of government services. Another drag and high cost of high debt to GDP thresholds is less economic growth for several reasons. Importantly, government spending makes up a large chunk of GDP and economic output in a modern economy. The consumer economy drives the majority of economic growth, but government spending does have a hefty impact as well. It also reduces strategic economic development opportunities a government can make. Historically, developed economies with high debt to GDP thresholds have less long-term economic annual growth than countries with lower debt to GDP thresholds. Lastly, the biggest risk in cost to high debt to GDP is a black swan event, escalating into systematic contagion. This could take the form of a currency crisis, a financial crisis, debt crisis in terms of borrowing or bankruptcy, or a credit liquidity crisis or crunch, etc. There's so many different ways that a black swan event could occur and how it can escalate. The domino effects are quite unpredictable. And one concern, for instance, is the velocity of money problem, which just means that when you have a crisis occur in one area, it tends to quickly escalate in other areas as well, as the velocity of money today, more than ever, especially in the digital economy, it can move so rapidly. A recent example of a UK Black Swan event, of course, is Black September of 2022. That's just what I refer to it as with the not so many budget. I don't need to parse over the details of the mini budget with Liz Truss and back in 2022, since most of the people in the United Kingdom actually, of course, lived through the volatile but brief events. And one thing that I do want to highlight in terms of what interested me most of all, seeing the events unfold and the financial fallout, was in the United Kingdom government bond markets in particular. And what had occurred there that surprised me most of all, not only was the rate of price declines in the bond market and the volume of liquidations, which I'll talk about, but overall the volatility in the United Kingdom bond markets, if it had occurred, for instance, in the US Treasury markets, arguably, at least I would argue, that would have caused quite a global fallout of unprecedented proportions. I don't really, essentially, you don't really want to think about what that would have looked like if it had occurred in the United States Treasury markets because of how much is tied to the United States Treasury markets. But in the United Kingdom, when the mini budget was proposed, the fallout with or bond prices in the United Kingdom debt markets began dropping, but a lot of the large asset managers, asset funds, for instance, pension funds or large money managers who held large quantities of UK government bonds, typically those funds use, for instance, trading algorithms or set price constraints that if a certain asset will decline in price, that it will liquidate at a certain price. What ended up happening, though, was because of how, again, this ties to the velocity of money problem, when the bond prices started dropping and large asset managers started liquidating, or funds started liquidating bonds, the volume of the sales were so large that it actually facilitated just a free fall in UK bond prices, facilitating ever more escalatory sell-offs. In the end, the Bank of England did intervene and acquired the bonds in terms of staving off arguably just a free fall in UK bond prices. This is important, though, to emphasize that from a regulatory perspective, even though the Bank of England did succeed in intervening, the rate of the decline in bond prices and the scale of liquidations were so large that if it were to occur, again, that could arguably eventually become an issue where, from my standpoint, I'm kind of interested in the fact that would there come a point where the velocity of money problem and the rate of fallout becomes so large that banking regulators and central banking authorities don't have time or the adequate resources to react to that form of systematic risk. Now, again, this is just a recent example of a black swan event. It's important to emphasize that regulators do try their best, of course, and have a variety of tools and instruments and policies to be able to hedge or reduce the risk of a black swan event and systematic risk. The problem with a black swan event is that you're trying to predict something you can't predict. Black swan events are unpredictable by their very nature, and regulators are often just reacting to the events and trying their best to predict what might occur, what risks could occur, but oftentimes they, just like generals planning to fight the next war, they often plan based off the previous war and end up miscalculating what that next war will look like. And the fog of war is not just real in war, but also when it comes to financial regulators and central banking policy. They're often dealing with the fog of war of trying to predict, well, what could happen and where will the risks occur. In the United States, another example of where this sort of velocity of money problem can kind of catch regulators off guard when FTX and other cryptocurrency market or exchanges ended up going bust. What happened? Well, that wasn't good, of course, if you had money there because it's gone. But the fallout was that there were other commercial banking institutions that had those crypto exchanges as clients at the banks themselves, the commercial banks, and they did have exposure because of the fallout from those crypto exchanges that failed. But what happened was that those banks there were bank runs, and the Federal Reserve and other regulators did comment that the digital the speed of digital money, people not just physically going to the banks to try to take out their money, but just online transferring their money out. There were even banks that had names that were just similar to the banks that had contagion risk, but the name was just similar to another bank, but they ended up getting hit, not failing, but becoming under risk and stress of seeing deposits leave. And this is just to emphasize that the velocity of money problem is so fast, or faster today than it ever has been. And again, regulators may not have as adequate of a tool set to react as quickly as they would need to, but that is something that the Federal Reserve did make note of when there were those cryptocurrency exchange collapses. But the fallout, of course, in the banking sector was interesting to watch. And again, that was where digital money did play a factor with the speed of bank failures and other banks getting hit with with risks that they technically didn't have, but they started to see client deposits run. After Liz Truss and the not so mini budget, one of the best ways that the fallout was sort of contained and the risks reduced was, of course, the fact that Rishi Sunak became prime minister due to his background. Arguably, the number one reason he was made prime minister was to quell the financial markets and ensure that the United Kingdom's long-term financial credibility, especially from the Bank of England's perspective, was sort of restored, and faith in the credit and fiscal responsibility of the United Kingdom was restored. I do just note this because later on you'll see that I personally try to um, pitch Rishi on economic, monetary, and fiscal theory that I had worked on because of his background. And the reason I had thought him a ideal potential prospect was because of his background and the fact that he was Chancellor of the Exchequer and arguably, just somebody who would have a very good understanding of all the different aspects of not just central banking policy, but also fiscal and monetary theory as well. Now, what are the options and how do you solve high sovereign debt levels? Because again, a lot of the developed economies in today's age have very high debt to GDP levels. And the traditional methods, just listed over here, typically are kind of grouped into the three different categories of austerity. You're going to try to cut expenses to pay down debt levels. You could, of course, raise revenue. Raising taxes is one of the number one ways, for instance. You can also attempt to grow your way out. This would involve trying to stimulate economic growth or some other metric that you're leveraging long-term growth. You're hoping that because it's a debt to GDP threshold, if the debt levels remain constant, but your GDP economic growth is higher and your economy is bigger, you can reduce your threshold levels. Now, one of the problems with growing your way out of it is it's oftentimes theoretical at first, and then it's a question of does it actually happen? The history of developing countries compared to developed countries, the problem is that oftentimes when you have excessively high, very high levels of debt, oftentimes it just becomes a debt trap and a debt spiral where oftentimes you just don't end up coming out of it. So it's very important to address high debt to GDP levels proactively if possible, because the debt spiral is definitely a concern. Bankruptcy is not ideal, and the self-correcting mechanisms can be volatile and painful with fallout. So eventually there is a way that the problem solves itself. It's just that it can be more painful and costly in the long term not to address the issue proactively compared to dealing with it proactively. Today, in the UK, since the October budget proposal, there has been quite a bit of discussion about and debate about black hole problems. Number one, is there a black hole? And if so, who was responsible? Now, I have a picture of Rachel Reeves and Jeremy Hunt. They've been kind of going at it over the black hole problems. I'm not really interested in adding any sort of talking points about the past black holes. I do want to showcase, though, that there are some examples of moving forward concerns about potential growing costs that could create future black hole problems for the UK government moving forward. And so looking forward, I wanted to point out two examples of potential growing costs that should just be, maybe more so highlighted. And the first is actually something that I was particularly taken by surprise. Well, not surprised, but I do think is very concerning, and that is local town council debt and deficits. For example, I was already well aware of Birmingham's long-term issues of fiscal debt as an example of a UK town council that's had long-term problems. What is concerning and potentially, an issue long term for the UK national government is the fact that London councils are starting to see a dramatic escalation in expenses, but also concerns about long-term financial stability. And this does end up becoming a problem for the national government because oftentimes making up the difference or intervening and stepping in is going to be the responsibility in the end of the national government. Now, London councils collectively they had a £700 million funding shortfall. Now, that was mainly due to housing and homeless pressures as of September of 24. The London Town Councils, this is what is sort of interesting, the rate of increase. They've seen a 10% increase in needing temporary accommodation between April of 2023 and April of 2024. So that just means year over year, there's been a 10% increase in demand for those needing temporary accommodation, homelessness or housing issues. Now that's the increase in demand by the number of people, but the costs due to needing expensive hotel costs, for instance, are up 40% compared to, so the costs are increasing 40% compared to the demand need of services increasing by 10%. And that's averaging about £3 million a day year over year. And so again, a 40% increase is quite a high rate of increase year over year that, if it continues to escalate, can create serious issues for London town councils, but also the national government is in terms of the shortfall. In 2023 to 2024, 29 of the 33 London boroughs overspent their homelessness budget by, again, a collective of total of £208 million. I'm just emphasizing that the local town council debt issues and spending issues end up becoming a national problem, but it's very important to talk about that as a issue because it's off the books technically from the National Bank of England perspective, but it ends up becoming a big concern if more and more town councils across the UK see ever higher issues in terms of their fiscal spending. Now, a second example, of course, again, of the rate of increase of expenses is migrant asylum costs. In 2016, the spending for those costs was around £410 million, but in 2023, that increased to £4.2 billion pounds. And that is of the aid budget, it went from 3.2% in relative terms to 28%. Now, that's a cumulative effect, but it's a very high effect or change over a short to midterm period of time. Now, the Institute for Public Policy Research has noted here just recently that the average cost of housing and supporting an asylum seeker has risen from £17,000 per person in the 2019 to 20 year period to approximately £41,000 per person in the most recent year over year here in the 2023 to 24 period. That's a cumulative increase of 240%. Again, those costs can long-term be unsustainable if they continue to increase because over here under the picture, I actually have, again, the median annual earnings for a full-time employee in the United Kingdom was approximately, as of April 2024, £430. Now that's your tax base if you want to think about an average. It's not the income average because you don't want to use that, since higher earners can typically tilt that number compared to the median income. But the basic annual salary for a member of parliament in the House of Commons currently is £91,000 and some change in April of 2024. If there were another 240% increase, cumulative increase in the cost for asylum seekers, that cost would go up from £41,000 to 98,000 and some change pounds. So I'm being a little cheeky here, but the cost for an asylum seeker, and there's no reason that the rate of change would be constant, but it would be higher than what a member of parliament makes. It's already currently higher than what the median UK earner is making, but that's also the tax base. And so it is a little lopsided or upside down if you think about how those costs of what your tax base is versus your spending, how that's working out. And I don't know what the solution is, but if it were to raise 240%, I guess the solution for the member of parliament would be raise MP pay. But I'm being cheeky. So the costs are just, you need to factor in the growth of costs over time, and that can cause future black hole problems. So moving forward, I'm more interested in, I guess, future black hole problems rather than past black hole problems. In June of 2023, John Cochrane, who goes by the name The Grumpy Economist, that's his blog, you can look him up, published a important work called The Fiscal Theory of Price Level. And at the time, I happened to, and I follow John Cochrane, and I was inspired by his work on a number of points that ended up planting some seeds that I worked on developing earlier this year into some academic, monetary, fiscal, and economic theories that I attempted to meet and pitch to and prospect Rishi Sunak on as Prime Minister in the United Kingdom. Now, John Cochrane's work is addressing a lot of different things. It's a very thick tome. I would suggest that you can get it or read it, or if you're interested in academic research. And what was of particular interest to me was the fact that John Cochrane had challenged some of the base assumptions of Milton Friedman and Chicago School monetary theory, but also different aspects of fiscal theory, and not only challenging some of the base assumptions, but pointing out limitations in the application of those academic theories. Now, again, he's really interested in inflation. I'm not here to comment on John Cochrane's work. You can go to John Cochrane and see what he says, because he has a blog, he has lots of research. You can have your fill of John Cochrane, the Grumpy Economist. I am just noting that I was inspired by and very interested and fascinated by some of the disconnects that he had originally pointed out. And at the time, that kind of just sat in the back of my head, on my back burner, mentally, that I was just intrigued by. And earlier this year, though, I sought to address many of those limitations. Always have been interested in applied economics. And in the financial space, I've always followed and been interested by central banking policies and tools, instruments. I also have a picture here and joke about the ongoing desecration of a dead economist. Walter Bagehot, his 1873 work, he's not the only one, but he does talk about the lender of last resort principles and essentially important foundations for central banking theory and policy. I was interested in creating economic and monetary and fiscal theories that would be able to bridge the gap with some of the limitations that I personally have seen in the actual real financial economy as well. And not just about the fact that central banking authorities sometimes, instead of acting as lender of last resort, they act as buyer of last resort, which can increase financial moral hazards, systematic risks, but also the fact that they're, again, due to the fact that there are high growing debt levels. Of course, the macro debt bonded slave question we talked about, and my research was focused on. I wanted to be able to, from an applied perspective, not just an academic perspective, be able to address many of these issues. And that's why I ended up going to the United Kingdom and attempted to set up a meeting with Rishi Sunak as Prime Minister. So I went to the United Kingdom for a couple reasons. First of all, I did want to get some Liz money, with Charles as the new monarch. Elizabeth's fiat currency, the pound, would eventually slowly go out of circulation. And I kind of wanted to get her money as important historical money, as kind of a, memento. She is important. And so I wanted to get some of that money before it went out of circulation. But I went to the United Kingdom in the end to try to pitch Rishi Sunak as Prime Minister because of the fact that, from my perspective, he was able to hopefully see the potential value of the applied aspects of the different theories and policies and instruments and different. I was also trying to set up a banking network and partnering with the Bank of England on a couple different things, but in the end, he could see the value. Hopefully, that's what his background in the financial space. He's been on the financial investing side in the private markets. Of course, in public service, he was Chancellor of the Exchequer. His heralding forth as Prime Minister due to the not so many budget. Of course, he was be as hopefully as capable of anybody really to understand some of the value and potentially agree to try to apply some of those different theories. Now, I personally just called, from an overview perspective, I called it expanded monetary theory and capitalization economics from an applied perspective of economic development. But not that it matters. I'm not going into the details. In fact, I would argue it's probably a very small contribution and arguably inconsequential to the conversation of monetary and fiscal theory. But I'm not smart like John Cochrane. I just I didn't know it. You don't know if you don't try. So I was attempting to pitch those. Now, in order to succeed, though, if I had met with Rishi Sunak, there was from my perspective, a requirement that if Rishi had agreed to, if he saw any of the value with any of the economic, monetary, fiscal theories, policies, etc., he would also have to win the election in July earlier this year, because as a decision maker, if he was not prime minister, it wouldn't have mattered, from my perspective. So walking into to try to meet with Rishi, I decided as well that I would have to attempt to add value of getting Rishi across the finish line from an election standpoint. And that's also why I created, originally it was all just economic and fiscal related research and theory, but I actually created a political theory for Rishi and different customized aspects of policy suggestions for him to run on for the campaign and the upcoming election, because his polling numbers were not good. And essentially, if he had agreed to any of it, from my perspective, it wouldn't have mattered because if he lost, I couldn't apply anything. So I needed, hopefully, to get Rishi across the finish line if anything was to be applied. So that's why I created, from a political theory perspective, Tory Democracy 2.0 as a vision for the Conservative Tory Party and for the United Kingdom for Rishi to present to the UK electorate. I will talk about that in the next video, but actually, I wanted to talk about a specific policy that I had crafted for Rishi as sort of a flagship financial policy for him to present to the UK electorate. And it is, in many ways, it was meant to address as the most number of people in the United Kingdom as possible from a beneficial economic policy, while also emphasizing Rishi's background and expertise in banking, and also to help the Bank of England regulators with an additional tool set. So essentially, it was covering killing multiple birds with one stone. But that is the UK Citizen Counter-Cyclical Capital Buffer Program, which parallels the Bank of England counter-cyclical capital buffer at the institutional level. Now, it's important to, in the next couple slides, we'll walk through the policy. I just wanted to showcase it as I thought it was a very good idea and it's worth putting out there. The Bank of England counter-cyclical capital buffer, this is meant to be a tool set that regulators can use to help reduce systematic risk. It is a way that they can increase capital at each individual bank in order to act as a hedge against any sort of systematic financial risk. So if there was a potential bank run, for instance, that allows regulators at the Bank of England to say, XYZ Bank, you're supposed to hold X additional capital funds on reserve. That way there is less risk in the financial system. Now, Rishi's UK Citizen Countercyclical Capital Buffer Program, the background for how I kind of crafted it and the reason why I approached the design as I did was it's important to cover this Bank of England important financial data when it comes to bank accounts and the UK citizen financial situation. So according to the Bank of England at the beginning of 2024, a third of citizens with banking accounts had less than £1,000 with 18 to 24-year-old cohort. So that group of especially younger UK citizens having 50% fall into this category. So it just means that younger people have less money. No surprise there. 1/7 of citizens have no money in savings. 1/3 would struggle in the United Kingdom to cover 1 month of emergency expenses due to an insolvency event. So an example would be job loss or large emergency. 2/3 of UK citizens would struggle to cover 3 months without borrowing due to, again, an insolvency event. And 2 out of 5 citizens worry about the number of the amount of debt that they owe, while 1/3 of citizens worry about the number of debt products that they have. The biggest trap to the average banking client is having too little money. Once an overdraft or insufficient fee occurs, the fees incurred set the client back even further. In relative terms, it's quite expensive being poor because every time there is a fee, even though the absolute amount may be not high, in relative terms, it is a high cost to especially the most at-risk banking clients. The stress of money and poverty is a constant stressor that leads to deterioration of both physical and mental health. Poverty is a health crisis as well. I thought of this design, as well as being an indirect way of saying, hey, Rishi, you can help improve the NHS situation with some good financial and economic policy as well, indirectly, addressing the 10 to 22 million UK citizens that fall into the category of struggling and squeezed. That's a Bank of England category, is the most materially impactful policy reform to the UK citizen without increasing payroll pension contributions, which we'll talk about here in the future slides. The private citizen countercyclical capital buffer program is structured as a reallocation of partial retirement pension contributions to fund and replenish the private UK citizen capital buffer account. This account is not accessible or liquid for the citizen while a productive contributing employee to retirement pension scheme or to the retirement pension scheme. The account is held at a approved commercial banking institution alongside other accounts, but it is a custodial for the benefit of the citizen. This buffer account will then be utilized by the commercial banking institution to cover any shortfalls incurred from a counter-cyclical event. So, for instance, if there was a insolvency event like a job loss or a unexpectedly large expense or something like that, it would cover that sort of an event. The size of the account would be based off national average and data, but for example, setting a goal of £1,500 would ensure that 1/3 of the highest risk UK citizens are protected from the worst excesses of the cannibalizing nature of banking poverty trap and those additional fees. It would save all third-party additional fees or disruptions as long as the capital account was not exceeded. So no late fees or missed payment for a credit card or car payment, for instance, on their end, since any shortfall would end up being withdrawn and covered from that countercyclical capital buffer account. Lastly, it was important to address that there would be a disincentive and penalty to the United Kingdom citizen who utilizes the program in excess. Now, there would be a reduced bank fee that would be charged against the countercyclical capital account for excessive use over a certain period of time. So, for instance, if there was somebody who is utilizing it too frequently, there would be a reduced bank fee that would be incurred. Also, retirement payroll contributions would need to be diverted to replenish the private citizen individual countercyclical bank account back up to the minimum levels. So in essence, the private UK countercyclical capital buffer account would provide a permanent margin of safety for a large portion of UK citizens most at risk of excessive fee cannibalization, while still providing for individual accountability, since there's no free ride and an imprudent user of the account would be cannibalizing their future retirement if they were seeking to abuse the account for non-counter-cyclical reasons.